Hi, my name is Jim Mitchell and I am the head of the America's Oil Analyst for Refinitiv. Today we have with us Mikael Bonalumi from Auriga Commodities and Audentia Capital. Mikael, welcome.
Thank you, Jim. It's nice to have me.
Mikael, what is the problem that trading firms are having with trade finance?
Well, there is a transformation happening in the commodity world today with regard to financing transactions foremost. The commodities market has changed a lot, especially the oil market since the 60s, 70s. As you know, at that time it was a world that was dominated by the Seven Sisters. There was no particular volatility, there were no traders, and no real need for financing. It was done through the balance sheets of the oil corporations. And then through time, as you know, you had various nationalizations. Market opened up by people like Mark Rich and other trading houses. They started to move oil from point A to point B. They stored it. And by doing that, they created a market, a spot market. A spot market that over time evolved enormously and multiplied exponentially the need of financing, because in an integrated value chain, vertical value chain, you had a lot of intermediaries. You have the guy who sourced from the refinery, another one who put it in the port. You had the trader that came and picked up the oil and delivered it to a port in France. And then you had the local distributor, a wholesaler that sold it on to local clients. So for the same barrel of oil, the need of financing just exploded. Also, it's important to understand that since the 60s, 70s, the oil price have, on a moving average, has directionally moved up. At the time we were pretty much fixed at $2, and then in the 70s we were trading around $10 to $20, and since then we've been practically trading between $40, $50 up to $100 plus. And of course that also has a multiplying effect of the need of financing. What happened was in 2008, where banks and others recklessly, allegedly, leveraged their balance sheet and took on risk that was not very diligent. And the response from politicians and regulators were that this had to change. So the rules of the game changed. So the Basel framework came to life, and we've been through Basel 1 and 2 and 3, and very soon Basel 4, which basically will regulate the leverageability of banks and corporations. And they will have a critical choice to make, do we keep the business with the same amount of equity, or do we reduce the business and therefore the returns? If we keep the business and put on more equity, the return on equity will reduce. So it's a tough choice to make for banks and corporations, and it will force them to only pick the best businesses. Audentia Global is a Cayman-based fund who will provide a third option, and we can talk a little bit more about that later on. Clearly, in this environment, it has become very difficult for small and mid-sized traders to live up to this, because what happens is that the trade finance banks, they have reduced the lines with small traders and mid-sized traders. If, for example, a trader that was operating in West Africa previously had none or very little equity with the bank that financed its transactions, had $500 million of lines, the bank now says, you're not using more than 100 on a continuous basis, so we will reduce those lines to 100. Furthermore, whether you use those lines or not, you will pay a subscription fee for that. It's like a take or pay kind of thing. So for the trading companies, that means that not only is it difficult to fill the pipeline of deals, because the market has become so much more difficult and competitive and transparent, on the banking side now you increase the cost of capital. And you sit with your fixed cost, your overhead cost with that. And that's going to make it very difficult, I believe, for small and mid-sized structures. So it's going in the direction to support the bigger corporations, and I would say the bigger trading houses that are not listed companies. So big structures that have a critical mass, but can still do can still lever their equity, because a listed corporation will not be able to do that to the same extent. So I would say that is the problem that these new regulations have created for some of the trading firms today.
Oh yeah, that does sound like a serious problem. How is Audentia Global solving these issues?
We propose various ways of attracting alternative capital. So not necessarily money from the banks, of course, but it could be money coming from individuals or funds that get attracted to the commodity space. The commodity market is an interesting value proposition. The default rates are very, very low, looking at the statistics 30 years back. And there is a lack of instruments, investable instruments, that will give very interesting fixed income returns for investors. And Audentia Global is trying to develop such a value proposition. And clearly we can accommodate absorbing risk alongside a bank by taking on, for example, first loss on a part of the equity. We can issue insurance. That's where Audentia Global and Auriga comes into play, whereas an investor will not feel comfortable with the physical risk, such as shipping, demurrage, waiting in a port, so performance-related matters or quality aspects. A company like Auriga or another trading entity can de-risk these products. So for a cost, they can take away some of this risk. And Audentia will be left with a cleaner product, a de-risked product that still has very interesting return proposal.
So trading firms of every size need an edge to be profitable. How important is physical data market sets to a person in your position?
Well, not only in my position, I would say that if you would look at a trader and people surrounding the trading department, be it management, business development, this kind of market information is incredibly important. I think when I was a young trader, we knew it was important, but there was not a lot of data points, and there were not a lot of people, providing these kind of data points. So we built up a lot of this ourselves in-house. We had small groups of staff that assembled, loading port data, ships coming, loading what product of crude oil, what dates, etc., etc. And we put all that in. Then, of course, we stripped the market, talking to counterparts, brokers, etc., about who was offering what cargo, who had done what deal, at what price, what product. And all that went into some kind of a small database over time that created a historical data set. I remember when I was head of fuel oil in Total, I think we had an incredibly well managed visibility on the Northwest European fuel oil market, because we had of supply and demand. Basically, we could see very well and very quickly what would come out of Russia and what the demand looked like. And so that improves your probability of being right incredibly. You know, you will not always be right in second guessing price scenarios, but it's a tool you need to have, that's for sure.
So it sounds like Audentia, Auriga, and Refinitiv not only help customers discover new opportunity, but more importantly, leverage their proprietary edge. Do you find that to be the case?
I think so. I mean, I think I started in the 80s, and for me, we've reached a point where a transformation we're going through transformation in these markets, and we have a new set of players populating the commodity space. These people who will be very important participants need to join up or ally with, you know, established commodity firms. Some of their management need to be educated in the risks and rewards and of the commodity markets.
Yeah. So Mikael, you and I have been in this industry a long while. What do you see has changed? And what do you see as the same from the days that we started?
I think if I take the second question first, I am impressed by the efficiency of this market. I think it is a market that works incredibly well for being so little regulated. It's very efficient in its manner to optimize and cut out discrepancies. It's competitive. But what has changed is really the size, the speed, frequency. I mean, that's really what has changed. And I think the population is changing. The type of people has changed. I think the background of people involved. It's almost like, I would call it industrialized trading in some shape or form. I don't know if that term makes any sense, but you know, at the good old times, it was like you know, you got in there and you took your phone and you started to call people, and and you created something out of that, which was enormous privilege because you originated a lot of business as a trader. I remember a very good friend of mine at Vitol already 10 years ago, if not more, and he said, you know, the traders that we take in now, they are so spoiled because they come into a machine that's already set and they're managing a franchise. Now, managing a franchise is not necessarily unimportant. It is important. But I would say that is maybe the biggest change, that before as a trader you originated business. As you know, today I think traders, they manage proprietary flows by large. I think that's what they do. When you're a trader in some of these bigger companies, trading houses, oil companies, trading arms, you're managing a proprietary flow.
So what advice would you give a young trader who's trying to cut their teeth in the industry today?
I look at my sons and friends, my friends' kids, and you know, a lot of them want to get into environment, new tech. They want to start their own companies and things like that. So I can imagine for a young person today, working in the oil industry looks really old school and backward. But to that, I would say that the oil industry has an incredible diversification. and is incredibly intellectually challenging. It's fun, competitive, and it's such an important industry that works and operates very, very efficiently and well. And clearly there are sides of it that needs to evolve with time. And what better way to be part of that, to transform that industry into something better, cleaner, greener? Because I think that's the direction the industry needs to go. Otherwise you will lose a lot of the investors.
Well, all right, there you have it. Wisdom from one of the masters of the unexpected. Thank you, Mikael Bonalumi from Auriga Commodities and Audentia Capital.
Thank you very much, Jim.